Good afternoon, ladies and gentlemen, and welcome to the STM Group results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via stm@walbrookpr.com. We will endeavour to answer all questions today. However, failing that, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I'd now like to hand you over to Chief Executive Alan Kentish and Chief Financial Officer Nicole Cole.
Brilliant. Thanks, Tom. Good afternoon, ladies and gentlemen, and welcome to the STM interim results presentation for 2022. As a starting point, really, bear in mind I'm not sure who's in the audience. I'll just cover off roughly what we do as a snapshot before we sort of move into operational highlights and financial numbers, etc. In a nutshell, we basically administer client assets. Invariably, these are in some form of wrapper to do with retirement savings, and typically that will be a SIPP business, a SSAS business, a CureOps. For those people who aren't quite sure what a CureOps is, I would liken it to basically an overseas SIPP. So it's regulated for us in Gibraltar or Malta. In addition, we have a life assurance business that's based in Gibraltar. Predominantly that looks at the UK marketplace for its type of products, so flexible annuities, etc., and portfolio bonds. And finally, probably, which is a bit of a differentiator, I suspect, compared to most of our peers, is that we also have a workplace pension solution for the UK auto enrolment market. So in terms of sort of what our focus, where we're going to, I guess it's easy to put this into various areas. One of the things I'm very conscious of is that our margins currently are below our peers in the market. You know, we are around about a 10% margin. Some of our peers are at a 20% margin. For me, that's a massive opportunity and arguably a challenge that for us to become more efficient, and possibly is one of the easiest ways of us growing our PBT. But looking into the various sort of pillars, from an organic growth point of view, I think I alluded to in the previous slide that we do have a wide range of products. We've got, in terms of personal pension side of things, probably around about 20,000 plus individuals as our members, and we also have a further 250,000 plus, 270,000 plus members in terms of auto enrolment, and that gives us really a good base from an organic growth point of view to offer more products to our members through the IFA and financial advisory community, and clearly that needs to be and will continue to be one of our growth pillars. We also have the opportunity to launch new products, again, with that broad range, particularly in the life assurance market with our life companies. I'd hasten to add that we don't take investment risk, we don't take mortality risk. Our life company is too small to take any of that sort of significant risk. It's more about these wrappers, these administration of client assets. But an example of these new products would be, for instance, our portfolio bonds, which can sit alongside basically a SIPP on a platform, etc. You'll notice that further in the slides, we've acquired a business which we announced earlier on this year. It's post the half-year results, and we'll come back to that. But acquisitions will remain a core part of our strategy. I touched upon the margin growth, investment in CapEx. I think to a certain degree those go hand in hand. We've done a fair amount of the heavy lifting in terms of moving our personal pensions and our life businesses onto our in-house system. What we now need to do is to focus on ensuring that wherever possible, we are automating that process so that we improve our margins. And finally, where do we carry out our businesses? Ultimately, we're originally a Gibraltar business, but that's a long time ago. Our focus very much now is UK centric. You'll see that our acquisitions have been predominantly UK in recent years, and a number of our products, even if they're written out of Gibraltar, are into the UK market. But to give you an idea roughly of the size of us as a small PLC, we're prior to the acquisition, we were 277 colleagues, and as I said, we've got around about 295,000 customers across that workplace pensions and personal pension space. So looking a bit more about what's happened really in the last 6 months and a bit after that in terms of where we are as of today. Recurring revenue remains predictable, solid. Attrition rates are where we expect them to be, and that gives us that ability to really build on what we have. UK corporate pensions, it's a really interesting space, this master trust space, and certainly the acquisition that we did back in 2019 has proved to be the case. Really an acquisition where the cost was very minimal in terms of what we've done, but we've built a reasonably sized master trust in that time, which turned profitable last year and will continue to grow given the dynamics of the auto enrolment market. I think probably something that's really worth focusing on is that our growth strategy from an organic point of view is very much working with strategic partners. We recognise as a small PLC, we haven't got abundance of resources, financial resources to just continue to build out a sales team. And the focus very much is about tying up with partnerships, strategic partners who already have that distribution. A reasonable example of that would be, for instance, IG Index, who we've partnered with to provide them with a white label SIPP. Previously, their partnership was with James Hay, who have their own platform. So by default, we become a provider that is not competing in that space. And we're seeing more and more of that type of thing happening in terms of those relationships, those independent platforms that need wrappers on their platform. And one of the benefits, and we'll come back to that a bit further down, is once we have that partnership, it's the ability to then offer those additional products alongside the mainstay of a SIPP, etc. Other recent changes, we've in effect had a board refresh. A number of the chairman has stepped down, as has one of the non-execs. We've now got a new chair in place, very much has a track record on growing businesses and really helping to drive us as a business and as a group going forward. Clearly, as an AIM business, we need to be an innovative growth stock. We're not of a size that we can rest on our laurels. And finally, sort of coming back to the operational model, I think it's fair to say that a lot of what we've done in the first 6 months doesn't translate into significant savings that come through. That's very much that, where you make changes in terms of structure, in terms of number of colleagues that you have within the business, clearly that takes some time to flow through before the savings come. But we continue to focus on that, recognising that we do have the opportunity to become a lot more efficient than we currently are. So I'll hand over to Nicole for some numbers.
Thank you, Alan, and good afternoon to everyone on the call this afternoon. I'll talk at a high level through some of the numbers on the financial highlights page of our presentation and then move through some more detail in each of our respective business lines. In respect of revenue for the first half of 2022, broadly in line with that of the previous year at 11.3 million. However, when you look at the adjusted revenue number, you note that there is just over £500,000 increase year on year, which really reflects the growth in our continuing operations and is roughly a 6.5% increase year on year coming largely from our pensions business, as we will see in due course. From a recurring revenue perspective, again, increase in recurring revenue. 93% of the business is recurring revenue, with a modest increase year on year, again, of about £500,000. And this equally reflects the positive organic growth in a number of our existing business lines, notably the UK pensions business, with the pensions business line making up approximately 81% of our total revenue contribution. In terms of profitability, EBITDA broadly consistent year on year. Our adjusted EBITDA, again, also broadly consistent year on year, with a number of one-off personnel and professional fees impacting that adjusted EBITDA number. In terms of dividend, unchanged relative to the prior year. And I think that that's us taking a slightly conservative approach with respect to dividends, mindful that we expect a number of things to come to fruition during the second half of the year. The business remains cash strong, cash generative, and is largely cash rich, albeit a number of regulatory requirements around cash. And again, there are a number of opportunities to enhance on free cash through some initiatives to reduce that regulatory requirement. I'll move on to the next slide, which gives you a bit more flavour for the revenue contribution by business line and operating segment. So as Alan touched on, we really have two core segments. Pensions, as I already mentioned, contribute 81% of the total revenue, and the life assurance business approximately 17%, with a small amount in other. As I already mentioned, a nice increase in the total continuing operations year on year, which reflects the continued positive organic growth within our UK pensions business. There's a little bit more detail on the next slide. I don't intend to spend too much time on that, but it again just gives you a bit of a sense for the split between recurring and reported revenues. And as I already mentioned, these continue to grow and reflect the stability of the business through its underlying revenue contributions from these recurring revenue streams. In spending a little while looking at a slightly more divisional review, starting in particular with the pensions business, which, as we already mentioned, is our largest business line, again, you see positive organic growth through increased member numbers in both the auto enrollment business, which is the corporate business, which you see on the top right-hand side of the page, as well as positive growth in both the SIPP and SSAS member growth for the period, with roughly 5,500 members. And Alan already mentioned the acquisition, which was completed on the 31st of August 2022, which will add roughly a further 3,500 members and give us further scale in that space. The CureOps business has again remained a mainstay of the business, really, and attrition rates remain broadly stable in that business line. Over the page, in looking at in a bit more detail at the pensions revenue, we see there, as I've already mentioned, the positive growth in SIPP and SSAS, as well as auto enrollment, which is largely from our UK business operations, and again demonstrates the not only organic growth in that business line, but stable recurring revenues that are being generated. Moving on to the life assurance business, which really we look at in aggregate across the two entities, both of which are Gibraltar domiciled. Again, we see a modest increase in that business line year on year, and predictability of annual revenue streams coming through. We hope to see some further growth in this business line in the latter half of 2022. We've included a slide which covers administrative expenses. This is a new slide relative to prior iterations of our deck, and is really intended to give some further granularity around our expense base. which really highlights that personnel costs are the lion's share of our cost base, with approximately 50% of our cost base representing the just under 300 employees that are spread across the group. However, it is notable that there has been a marginal decrease in personnel costs, and this is broadly in line with expectations relative to the same period last year. We continue to invest in technology, and we see some marginal increase in that cost, and equally professional fees have increased modestly. I think it's really when we look at this cost base and the administrative expenses in particular, where we see some opportunities in terms of optimizing our operating efficiencies across the group, and this remains a core focus for the board and the executive. Moving on, I'll hand back to Alan to give you a little bit more detail around the acquisition that we've recently completed.
Thanks, Nicole. There's no doubt in my mind that the acquisition of the SIPP and SSAS business from Mercer is an excellent acquisition for us. And to be fair, we're very pleased that Mercer chose us out of the various different individuals that could have acquired this business to move forward with us as the partner. As we've said in terms of the announcements previously, this doubles our revenue in terms of the SIPP and SSAS book of UK business, and really sort of cements that strategy about that focus in terms of being UK centric in terms of that space. It's particularly interesting in terms of the split. The SIPP business is probably adding 50% to our existing SIPP numbers, but the Mercer book of business, the SSAS book, is significantly bigger than our current book of business, and hence you get this sort of slightly difference in terms of the membership numbers compared to the fees per member, having the mixture of SIPPs and SSASs. What it does mean is that we create a centre of excellence within our Cardiff business, where we have 30 odd colleagues in relation to that SSAS and the opportunities that come with that. And it's probably a good example of that strategy about partnerships, where having that relationship now with Mercer, where potentially if they do acquire other businesses that come with a SIPP or SSAS book, we would be obviously a partner of choice. The Mercer book in itself came from JLT Wealth Managers, who continue to be the wealth manager of a number of these SIPPs, and again, therefore, we build out that relationship. The dynamics themselves, I think it's fair to say, acquiring circa 2.7 million of revenue at a cost of 3.3 million, but coming with 0.9 million of net assets is clearly a good acquisition from our point of view. I think a couple of things worth just bringing out in terms of that acquisition. One of the things that I think all parties looking at the personal pension sector in terms of the UK market and the international market is the quality of the book of business. Ultimately, there's clearly scenarios that the Kerry Adams case, which is one within options, which I hasten to add has no financial impact on us, but does bring in additional costs in terms of that management of thereof. The Mercer book is incredibly clean in terms of not having any esoteric assets or distressed assets, as we might call them, and that's nice and tidy from our point of view. From an operational point of view, it will deliver circa 0.8 million of EBIT once fully integrated. The nice thing from our point of view is that it is a well-run business. It is already delivering that profitability, whereas you'll notice a number of our acquisitions in the past have been about acquiring something that is not necessarily performing to that level and us requiring to deliver those efficiencies. This already comes with a decent operating margin, and therefore the opportunities to increase that margin, or at least, at the very least, maintain that margin as it contributes towards us as an overall group.
Equally, we will take the latitude, given that it is a well-run, profitable business as it stands, to give ourselves time to fully integrate that business, and hence don't expect there to be any positive contribution to our bottom line from this business during the course of the current year. And equally, in 2023, expect 0.3 million of PBT to be contributed from this acquisition, but that grows to at least 0.6 million from 2024 onwards as that business is fully integrated within the STM fold.
So in terms of that being the 6 months, where does that leave us as of today? I think it'd be remiss of me not to really confirm that at the half year stage, clearly the reported PBT is behind the curve as to the run rate. We are comfortable in terms of the full year numbers of a 2 million PBT prior to including the acquisition. You would have noted in the RNS statement for the acquisition, because of transactional costs, there'll be a negative contribution of 0.3 million in relation to that over the next 4 months, bringing it to the 31st of December. However, why are we comfortable and confident in terms of those numbers? There's a lot that's happened really since the half year stage. I think it's fair to say that Nicole alluded to the fact that we're expecting and we are receiving significant uplift in terms of revenue in certain products within our life company. This is not something that's sort of come knocking on the door over the last 2 to 3 weeks, but much rather has been part of a discussion with a number of intermediaries over a sustained period of time, 9 months, 12 months, etc. And that now is starting to come to fruition. And that gives us that level of certainty for us to be able to say, as management, we are comfortable with those expectations. Other things that are currently in process, we spoke briefly about the acquisition. Clearly, one of the fundamentals for us is ensuring that we work through the transition stage with Mercer over the next couple of months, and that actually as part of integrating that into the group, that we obtain the benefits that we expect to obtain. And that will include things like interacting with the intermediaries that previously came through Mercer, interacting with those intermediaries to ensure we continue to get support and new support for the SIPP and the SSAS business that we've acquired. We've spoken in terms of the RNS over the last few months, in fact, probably over the last 9 months, about the progress we're making in relation to our in-house system, administration system called BOSS. That continues to move forward. We have all of our businesses now onto BOSS, and i.e. we have one administration platform for our personal pension and our life business. The key now is to ensure that we continue to deliver and improve efficiencies within that system. There are still too many manual interventions in terms of how we do things, and that is part of basically a program to automate some of these processes and really challenge that. You know, the admin costs, the 6 million over 6 months, $1 million a month is our staff costs, to really challenge and see how we can become more efficient and start to eliminate some of that cost base. And I'm confident that we've got the tools and the equipment to do that over the next 6-12 months, you know, as we move from 2022 into 2023. In terms of acquisitions, I don't see us doing any acquisition in the short term at the moment. We've clearly acquired the Mercer business, and we've drawn down in terms of that credit line within the bank as part of looking forward. You know, it will continue to be part of our strategy, but we do need to make sure we've delivered on the integration of the Mercer business. So I think it's fair to say that there's a lot to aim for in terms of the next 6-12 months. There's the efficiency we've spoken about, but I think the area that we really haven't capitalized on in the first 6 months, and it does come out in the RNS, is that new business and those new business opportunities. There's no doubt that the process of our strategic partnership program has the ability to pay very significant dividends. A good example would be, for instance, IG Index. We will sit on their platform and offer the SIPP proposition for them. That will, in terms of their run rate, would expect to deliver circa 40 new SIPPs a month to us. So in terms of that as a new business flow, it's very significant when you look at the new business that we have currently received in the last 6 months of this year, as per the slide previously. And one of the things that we are seeing really in terms of that organic opportunity is where we are offering a SIPP solution, is that invariably these platforms, whether they're the IG or whether potentially IFS, which is a smaller platform that we work with, and a number of others that are coming on stream, they're also interested in our other products, such as the portfolio bonds, such as the flexible annuity. And really the opportunity for us in terms of ensuring we build out our distribution is around getting these products that are on our shelf at the moment onto those platforms. I think it's fair to say one of the frustrations is that timescale is not always within our remit, and that because we're working with some larger parties, other parties, we're possibly further down the priority list than we would like. But there's no doubt the opportunity's there, and we continue to explore it, and we are making progress on those areas. So I think, by the time we get going into 2023, and I'm conscious there isn't a research note out yet. I think FinCap are intending to put something out next week, which will look at 2023 numbers. As we move into 2023, there's a lot of upside. There's a lot of ability to reduce our cost base in terms of improving margins. There's the organic side of things, etc., and then there's the annuities, etc., that we've alluded to in terms of some of these niche products that currently haven't delivered the volumes we expect, but we're now seeing starting to come through in terms of the second half of the year. So in that regard, I'm sort of happy to take questions. I don't know, Tom, if I
yeah, absolutely. Yeah, great. Yeah, okay, great. Well, that's super, Alan. Thank you, Alan. Thank you, Nicole. If we could turn to the questions, we had a number of questions submitted ahead of the presentation, but for those in attendance, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. One of the questions that was submitted, I think you've just answered actually, which was expanding on the distribution network strategy, having noticed the IG deal. I think you've given a pretty comprehensive answer to that. But maybe there are two questions actually on the Mercer acquisition. If I can pull those two together, that might be helpful. But the first of the questions is, how is the integration of Mercer acquisition going? And the second one, which Matthew submitted during the course of the presentation, was you mentioned the competitors for Mercer. Why do you think they chose STM? I don't know whether you could talk around those two issues quickly.
Yeah, sure. In terms of the integration, it's early days. The reality is, and this is one of the potential challenges of dealing with a US blue chip company, is that until really we completed on the deal, we weren't really allowed to get involved in terms of any integration and pre-planning to a certain degree. So that's now started in earnest from the 1st of September. We've done as much homework as we could. We've specifically in this scenario taken on a integration manager on a consultancy basis. The benefit of that primarily is that they actually did work on a previous integration for another business that was acquired from Mercer. So we've learned some of the nuances of dealing with a large US blue chip. And there's some really interesting scenarios, like my quote that when we announced had to be pre-signed off 6 weeks prior to announcing the transaction. But as it stands, Mercer are very much working with us, literally hand in glove, in terms of ensuring an orderly handover. It's as much in their interests to ensure that that's handed over correctly, because obviously it's also a reflection on them in terms of the client base. I'm pleased to say all of the communications to clients, etc., have gone down extremely well. One of the additional benefits that came out of it in terms of partnerships, etc., was the fact that Mercer was doing some TPA work for Phoenix Reassure, in terms of their SIPP and SAS book, and we've now obviously taken that over as part of the acquisition, and that then has given us another strategic partner in terms of Reassure, who potentially have some other books of business for us to look at. So they've been very reasonable in terms of how they've dealt with us. In terms of why were we chosen, I think it's a really good question. And sometimes I sort of scratch my head and try and work out why were we chosen. I sort of likened us as to sort of the little STM pony against some much bigger players in the book. And I think it comes down to our view of how we like to treat clients. And I'm not saying our service levels are the best and top drawer, but certainly we aspire to offer the service levels that we retain clients, etc. And I think that came across as part of what we wanted to ensure happened to the clients that Mercer had as part of that. So I think we didn't push things. We regarded it as a solid and slow integration, which again was important to Mercer from the point of view of the Mercer staff that we were taking over. We weren't coming in sort of splashing and burning as such. It's going to be about working to them and creating a centre of excellence on their SAS side of things.
I think, as Alan already said, in welcoming 30-odd staff that have come from the Mercer side of business, based down in Cardiff, that again helps to reinforce our UK-centric position with respect to that pensions business, and certainly at this stage are really delighted to have that Cardiff presence and office and welcome those staff to the STM fold.
Great, super. Just staying on the M&A theme very quickly, and I know you have already mentioned that you're unlikely to make another acquisition soon, but Steve asks, how much focus do you spend on M&A and what capital is available to you to do deals? And I wonder whether you might just include in that, what a good looking deal looks for you in terms of sort of the shape and size.
Yeah, so it's a good question. We have one person dedicated to M&A work and, if you like, special projects, and that might be partly aligning part of the group, etc. The way that we've approached deals invariably is that this individual will lead the project. We typically mostly co-opt individuals within our group to help us with the due diligence. We've got more accountants than you can shake a stick at, so we'll do any financial due diligence in-house. Typically we'll outsource the compliance to a compliance specialist firm who specializes in that regulatory side of things, and that's just to get additional comfort over any acquisition. And given the marketplace and the industry sector and the typical approach by the FCA, a lot of that due diligence will be on the quality of the book of business. That sort of comes back to this Kerry Adams scenario as to what is the SIPP provider responsible for in terms of the underlying investments. Clearly, they can't advise on the investments, but at what level do they have that due diligence criteria to ensure that the asset is bona fide and should deliver what it says it's going to deliver? So that will be a big focus of any due diligence. Where do we get to? I think it's fair to say we've drawn down our credit line as we stand now. Part of moving into 2023 and delivering enhanced profitability will also be about then looking at negotiating additional debt facilities, etc., so that we can continue on that acquisition side of things. I think it's also fair to say that the acquisitions will sit within the SIPP and SAS space typically. I think the master trusts, not that there are many around there that would be able to would be for sale, but actually the price would be prohibitive for us. You know, we can grow our membership by circa 80,000 members per annum, which is arguably 1.5 million of additional run rate revenue through an organic process, etc. So it would be very much the focus on UK personal pensions environment. Anything to add, or did that cover it?
I think just to add to the capital conversation, yes, as Alan mentioned, we have a bank line that we've drawn on for this and a previous transaction, which is now fully utilised. I think we see opportunities potentially to reduce some of our solvency requirements and capital that we hold from some efforts around synergies within the two life companies coming together, and we continue to explore those options as well. You know, we are a cash-rich business, albeit that we have total regulatory requirements of just under 17 million, but there are some opportunities there to create some free cash through looking at opportunities to reduce those solvency requirements.
Great. Okay. Well, Reg Cap, interestingly, you raised that because both Joris and Philip both asked about the Reg Cap requirement. So we've ticked that one off. That's great. There are two questions actually, which both relate to the operating model and margin. So Richard and Sam, can I just possibly put these two together? So Richard said, do you see the use of improved technology as the key to reducing admin costs, which in turn will underpin the strategic aim of increasing margins? And Sam had asked, what are the longer term ambitions for margin, and are you seeing using technology to enhance this as you expand? So they're both similar in style.
So I can jump in and maybe answer the first one in part. Use of improved technology. I think there's been a significant investment in technology over the last couple of years. As Alan mentioned, we now all operate on one core in-house developed system called BOSS, and certainly there are further opportunities to enhance efficiencies around the operation and utilization of that system. But equally, we've invested over the last 6 to 9 months in other core operating systems that support not only finance as well as risk functions across the group. And certainly that group-wide use of technology certainly does provide opportunity for process improvement, which will hopefully result in reduction in admin costs.
I think I can add a bit onto that. I'm just checking that I haven't got a GPS tracker on me, because I've literally just come from a meeting where people were presenting some of front-end technology that will make our business more efficient. And it's none of it's rocket science, and possibly shows where we have a real opportunity to cut costs. You know, it was to do with basically straight through online onboarding, automated onboarding of clients, etc. We still have within our business too many manual interventions, and that's a really good example of taking other people's technology and linking it with our admin, our sort of core admin system that does what it says on the tin in terms of the database and the receptacle. But there is it's not about us inventing new technology at all, it's utilizing what's already out there. And I think it is the ability for us, given that we haven't got really the legacy systems that possibly some of our competitors have, it gives us the ability to really tap into some of this new technology and to use that in conjunction with our database and admin system. So where could that take us to? I think it's fair to say most of the market operates at around about a 20% margin. We're currently at 10%. So in theory, moving just to be similar to other businesses should allow us to put additional £2 million on the bottom line. If you look at, I think Curtis Banks, recently came out with a statement that their aspirations are to move to 30% plus margin by 2025, I think it was. And I don't think those are unreasonable margins, given the ability to rely on some of the technology coming through. And some of the areas that we've been particularly, I was going to say bad at, it doesn't sound right, does it? But particularly too much manual intervention is around things like dealing instructions, etc., that we receive on behalf of SIPP members or QRops members. And a lot of that can be much more automated in terms of that process. It also gets rid of any potential manual errors. And that's very definitely a focus for 2022, 2023. That in itself has the ability to be a game changer, in my view, in terms of our profitability.
Great. Okay, much to go after. Super. All right. Well, look, thank you, Alan. Thank you, Nicole. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide feedback. If anyone has any further questions or would like additional information on STM, please do get in contact at stm@walbrookpr.com. In the meantime, many thanks for attending today's presentation.
Thank you all.